Phillip Futures webinar. I'm Joyce Liu, Investment Analyst with Phillip Futures. After two large plunges in April and June this year, gold prices are on track to its biggest yearly losses in 2 decades. But at the same time, we saw some impressive gains in the last month, with gold prices headed for the 5th straight week of gains. This begets the question, are gold prices poised to reverse to the bulls? We seek to answer this question today. Disclaimer. The purpose of this presentation is for general information and education only. For investment advice, please approach our Phillip Futures representatives for an analysis of your risks and returns. Gold prices have been bearish since the beginning of this year, but have registered some impressive gains recently. Specifically, prices have rebounded more than $200 from its low of $1,180.71 per troy ounce on 28 June. And the 4-week winning streak is the longest this year. Price momentum, indicated by the Moving Average Convergent Divergence (MACD) chart, shows positive momentum since mid-August, also for the first time this year. And RSI, the Relative Strength Index, remains close to oversold. Zooming into the hourly chart, we have given back almost all the losses since the June plunge, despite almost one-sided bearish call on gold prices by banks, brokerages, and trading houses. The strength in gold prices is beyond doubt, and the question that we are interested in is the recent strength a temporary phenomenon, or is it a more permanent reversal in trend? To address this question, I will first explain the cause behind the recent bullishness. Then, I will highlight the underlying bearishness. And lastly, wrap up with potential investment avenues through which we can potentially express our price opinion for gold. So firstly, why the recent bullishness? 3 factors: strong physical demand, seemingly tapering electronic investment demand, and technical strength. Strong physical demand. This is a chart that I plotted using data from World Gold Council's most recent quarterly demand trends. Jewelry demand in second quarter is the highest in 4 years. In fact, it is the highest quarterly demand since fourth quarter 2007. This is unsurprising if you remember how buyers across Asia made a beeline for gold jewelry shops after the April plunge in gold prices. There were anecdotes of gold jewelry shops in China running out of gold, and in Singapore hiring double their usual manpower in order to serve the sudden increase in customers. Premiums in Asia also shot up to multi-year highs. Back to the chart, notice that not only is the second quarter 2013 jewelry demand the highest on the chart, it also bucked the seasonal trend. Second quarter jewelry demand tend to take a dip from the previous quarter, as Chinese buyers tend to buy gold during the festive season of Chinese New Year in the first quarter of each year. So yes, jewelry demand is strong. The other source of physical demand is physical bars and coins. The green bars added to the chart represents demand for physical gold bars and coins. Physical gold bars and coins demand is the strongest ever on record. In fact, the US Mint reported an average monthly coin sales close to 100,000 for the first 7 months of this year, almost a 3-fold jump from the long-term monthly average sales of about 39,000. Physical demand for gold was strong. Recall that in our previous webinars, we discussed that the division in sentiments between physical buying and fund selling was the reason for high volatility in prices. And the winner of this tug of war is likely to determine the outlook of price direction. So now let's take a look at what has happened and what is happening to fund selling. In second quarter this year, there was an outflow of 508 tons of gold from gold ETFs and other gold-backed paper assets. This is the largest ever in history. In fact, the outflow began late last year, when speculations that the US economy is out of recession into recovery resulted in investors pouring out of gold into US equities. Let's take a look at gold holdings in Spider Gold Trust, world's largest gold-backed ETF. The investment outflow from the ETF is the largest and longest since the financial crisis of 2008. In fact, since the establishment of the fund in November 2004. The outflow since the peak on 27 December 2012 has been 32%, or 13.81 million troy ounces. However, the end of the chart seems to show some evidence of tapering. For the last 1.5 weeks, we have witnessed intermittent inflows to the gold-backed ETF. This begets the question, is the investment outflow from gold coming to an end? Quite possibly so. According to the latest SEC quarterly filings, John Paulson, the largest buyer of Spider Gold Trust and reputably the biggest gold bull, halved his gold holdings in the second quarter that just passed. Other heavyweight billionaire hedge fund managers who had previously expressed support for gold prices, George Soros and Daniel Loeb, almost completely sold down on their Spider Gold Trust exposure. With such heavy selling down already taken place, there is likely not much room for further dramatic selling. The last bullish factor, technical strength. The technical bullishness in gold prices are unmistakable. Firstly, it has been making higher highs and higher lows since June 28th. Secondly, prices broke through key psychological levels 1300 and 1400. In particular, gold prices broke through 1400 almost without hesitation. Thirdly, price momentum on the MACD chart shows mostly positive price momentum, in contrast to the first half of the year when MACD was below the zero line most of the time. Lastly, the crossing of 100 period simple moving average above and below the 200 period simple moving average has been a reliable and rather dynamic confirmation of bullishness and bearishness in gold prices. And 100 period SMA crossed above 200 period SMA in early morning 13th August. So on top of strong physical demand and signs of tapering investment outflow, technical strength has also been supporting gold prices. Next, we will explain the underlying bearishness. 3 points. Ben Bernanke's true intentions with regards to stimulus tapering, what his friends, the Fed presidents from different states, are saying, and economic data that the Federal Reserve claims their policy decisions are contingent upon. What Ben Bernanke had been saying seemed self-contradictory to many, and as a result, inducing much volatility into gold prices, which at the moment is highly dependent on the likelihood of Federal Reserve paring back on their open-ended $85 billion monthly bond buying stimulus. On 19th June, in a post-FOMC meeting press conference, Mr. Ben Bernanke said that the committee sees the economy as most likely involve continuing gains in labor market and inflation moving back toward the Fed's 2% objective, and that if the incoming economic data is broadly consistent with their economic projections, he would deem it as appropriate to moderate the monthly pace of purchases later this year, possibly even ending it by mid-next year if the economy continues to improve at the rate projected. Yet, 3 weeks later, during a speech in Massachusetts, he said Federal Reserve has a dual mandate of maximum employability and price stability, and both sides of our mandate, both the maximum employment side and the price stability side of our dual mandate, are saying we need to be more accommodative. This seems to be a direct contradiction of what he said earlier in June. Very soon after, on 17th July, during his congressional testimony, he shed some light about what he was hoping for when he said that the committee's basic tool for providing monetary accommodation is its target for the Fed funds rate. He added that asset purchases are extraordinary tools employed only because the Fed funds rate has been close to zero since late 2008 and cannot be reduced meaningfully further. Combining the content of these three key speeches, I think what Mr. Ben Bernanke is trying to say is, we will keep our monetary stance highly accommodative for now until we can provide further justification for economic recovery. Meanwhile, please adjust to the concept that accommodation in the context of monetary policies mean low Fed fund rates only. So when we eventually start tapering our 85 billion bond buying, please do not misunderstand us and run into a panic, jacking up bond yields like what you did in June. Indeed, the greatest fear of Federal Reserve is that market interest rates rise without any upward adjustments in Fed funds rate. So here is Mr. Ben Bernanke, who has all the incentive to do something about the asset bubble risks before he retires in January next year. He has a reputation to defend. Outspokenly supporting him are several other Federal Reserve presidents from different states in the United States. In particular, Chicago Fed President Charles Evans, a voting member of the FOMC this year, said on 6 August, "We are quite likely to reduce the flow of purchases rate starting this year. I couldn't tell you exactly which month that will be, and it's likely to wind down over time in a couple or few stages." He later said that he would clearly not rule out starting the pullback next month during the September FOMC when asked if it's likely. Other than Charles Evans, other Fed presidents have also expressed similar sentiments. They include Cleveland Fed President Sandra Pianotto, Atlanta Fed President Dennis Lockhart, and Dallas Fed President Richard Fisher. Lastly, let's see what economic data is saying about the US economy, whether it is ready to cruise on itself should asset purchases be cut back. We are looking at 3 different types of data: labor market, prices, and consumption and business sentiments. The first 2 sets pertain to the dual mandate of Federal Reserve: maximum employment and price stability. The last set is a reflection of the expectations and confidence in economic outlook. So first, labor market data. Initial jobless claims measures new and emerging unemployment. It is evidently on a largely declining trend. Initial jobless claims is a weekly data and is usually released every Thursday at 9:30 p.m. The next piece of labor market data is the non-farm payrolls data. Non-farm payrolls measures the number of jobs added or lost in the economy over the last month. It does not include farm workers, private households, non-profit organizations, and government employees, and is therefore a better indication of the employment situation as a result of changes in business cycle and economic outlook. At 162,000 in the month of July, it is a slight drop from the previous 3 months, but is still considered satisfactory. An increase to the range of 180,000 and above will be affirmative of stimulus tapering. Non-farm payrolls is usually released on the first Friday of each month at 9:30 p.m. The last piece of labor market data is unemployment rate. The unemployment rate targeted by Federal Reserve is 6.5%. The last reading for the month of July was 7.4%, a good improvement from the 9.1% 2 years ago. Unemployment rate is usually released together with non-farm payrolls. Moving on to prices data, inflation in the month of July was 2%, and the preferred measure of inflation by Federal Reserve, the core inflation rate, was 1.7%, below but close to the 2% objective. Lastly, consumer and business sentiment data. Consumer confidence, which reflects consumers' perceptions of current business and employment conditions and the expectations for next 6 months regarding business conditions, employment, and income. It has been on the rise. The last reading in August was 81.5, an increase from July's 80.3. Retail sales measures the aggregated sales of retail goods and services from the same month last year. At 5.4% in July, the improvement in retail sales is reasonably good. Lastly, to measure business sentiment, the amount of new orders placed. New orders placed is a leading indicator of GDP and heavily impact business confidence. The last reading for June 2013 hit a record high of 497 billion USD. In summary, despite the recent drop in new and existing home sales, the traditional indicators of economic outlook does seem to point to overall recovery in the economy. And this, if it continues, provides the grounds for reducing stimulus. So where are prices likely to be headed? In the larger scheme of things, it is almost inevitable for gold prices to take another plunge when the decision to cut back on stimulus is made later this year. Gold prices may fall back to as low as $1,107 per troy ounce. This is the 61.8% retracement level from the high of 1,800 touched once in 2011 and twice in 2012 to the low of 680 back in fourth quarter 2008 before the first round of asset purchases was introduced. But in the shorter term, we may have more upside potential, though the scope is limited. The fundamentals for more upside, strong physical demand, tapering investment outflow, and technical strength are still more or less intact. However, there has been strong profit taking as the relative strength index on both the hourly chart and the daily chart rose to overbought territories. In addition, higher highs on the price chart are accompanied by lower highs on the MACD chart, indicating bearish divergences. That is to say, the strength in the most recent gold rally is diminishing. While the upside is limited to about 1476, highly unlikely in my opinion, the short-term retracement to 1354 is highly likely. With that, let us explore some avenues to invest in a potential downward movement in gold prices. There are 4 common avenues to invest in gold market. First, gold mining stocks. Gold mining stocks can give us potential excess return over and above the return on gold prices, but only during periods of rising gold prices. It does not necessarily track gold prices well. In fact, most of the time they don't because there are many other factors to consider. For example, company management, solvency, debt management, and other risks. Second, physical gold bars and coins. This is a top favorite for Asian investors because we can see and feel the physical gold, which can also be bought in small amounts of 1 gram and 1 troy ounce. However, it is also the most expensive way of investing in gold prices because they usually come with a physical premium of 10 to 20%. The third way is via gold ETFs. ETFs are good because they are cost-effective and tracks gold prices very well. But for investors looking for leverage, ETF is not a good option, and in a bearish market, we cannot short sell an ETF without incurring borrowing costs. The last way is via gold futures. Gold futures, just like gold ETFs, are cost-effective and tracks gold prices very, very well. It typically gives investors a 15 to 20 times leverage, which multiplies both gains and losses. The best thing about futures is, in a bearish environment, gold futures can be shorted to express the bearish view. So now let us take a look at 3 contracts. Firstly, the COMEX gold contract, which is the world benchmark for gold futures. It comes in a contract size of 100 troy ounces and is denominated in US dollar per troy ounce. For investors who want to trade a smaller contract, we have the Tocom gold contract available. It comes in a contract size of 1 kg, which is about 1/3 the size of the COMEX gold contract. However, investors have to bear in mind that there is currency risks as the contract is denominated in Japanese yen. The last contract, which is not launched yet, is the Bursa Malaysia Gold contract, which is even smaller, 1/10 the size of Tocom Gold contract and 1/30th the size of a COMEX Gold contract. We look forward to the approval and the launch of this gold contract. We have now come to the end of our Gold Outlook webinar for August 2013. For more information on the risks and returns of trading gold futures, please approach any of our Phillip Futures representatives. Thank you, and please stay tuned for more market updates. I'm Joyce Liu, Investment Analyst with Phillip Futures.